Very good afternoon, learners. Welcome to another session of Financial Management. I am Dr. Neha Seth, working as an Associate Professor with School of Management Studies, Indira Gandhi National Open University, and today we are going to discuss dividend decisions. So let us start this session with the understanding of the meaning of dividend. So what do we understand by this term called dividend? So let's start our session with the definition of dividend. So what do we mean by dividend? So dividend is basically that portion of profits, that portion of company's earnings which is distributed to shareholders or which is distributed among the shareholders in the form of reward. So it is as a reward which is given to the shareholders for their investment in the company. Just because our shareholders, they are having trust on us, they have invested in our company. So as a reward, as a return, the share of profit, the proportion of profit we are giving back to our shareholders is called dividend. And this dividend is often distributed according to some regular schedule. It may be distributed annually or maybe quarterly or maybe semi-annually. So it depends upon companies to company that how they are distributing the dividend. So what do we understand by dividend? So dividend is basically that part of company's earning, or I may say that part of profit which is distributed among shareholders as a reward for their investment in the company. And this dividend is often distributed on a regular schedule. Okay. So let us move with this term called dividend policy. Now we understood what do we understand by dividend, then what is dividend policy? So dividend policy involves the balancing of shareholders' desire for current dividend and the firm's need for future growth. So basically it involves the decision or taking the decisions related to dividends, whether the amount of dividend is to be distributed now. Shall we give this amount to our shareholders in the form of dividend, or shall we hold this amount with ourselves as a firm so that we can reinvest this amount and we can help our firm to grow further? So these kind of decisions, when we have to take these kind of decisions, the policies we need to make while taking these decisions are called dividend decision. So basically the amount that needs to be distributed among shareholders or the amount to be retained. When this kind of decisions we need to make, these decisions falls under the category of dividend policy. Okay. Now, why these decisions, why dividend decisions are important? Of course, in previous sessions, I told about that this is the third most important decision when it comes to financial management. So the first decision was financing decision, where a financial manager decides that from where he needs to arrange the funds, at what cost the funds need to be arranged. The second important decision a financial manager needs to take is investment decision, where he decides that where to invest, how much to invest, for how long he needs to remain invested. And the third important decision about which we are having our discussion today is dividend decisions. Of course, dividend decisions are third most important decisions to be made by a financial manager. But why these decisions are important? Because these decisions, when we are taking these decisions correctly, these are helping us in maximizing the present value of the firm. And not just the present value of firm, it also helps us in meeting the ultimate aim of financial management, that is increasing or maximizing the wealth of shareholders. At the same time, these decisions helps us in maintaining the liquidity for the firm to meet its obligation either to government or to debt holders. So sometimes the company has some kind of obligation. They need to pay some amount in future. They are bound by these kind of obligations. And for meeting those obligations, what percentage, what amount they need to maintain in the form of liquid, so that this amount will be readily available to meet these kind of obligations. So dividend decisions helps us in deciding that what amount we need to keep in the form of liquid assets. These decisions are also important because these are helpful in providing returns to shareholders to maintain goodwill with the owners of the company. So the goodwill will also increase in the eyes of the owners if we are able to give good amount in the form of dividend to our shareholders. So because this is something they are getting in the form or as rewards. Okay, shareholders are looking forward to this amount. And then these decisions are helpful in deciding the proportion of earnings to be distributed and the proportion to be retained in the form of retained earnings. So whether we are giving dividend or not giving dividend, this is the first decision. If we are dividend, then how much amount, how much percentage of profit we are giving to our shareholders in the form of dividend, how much percentage of profit we are retaining with us so that we can reinvest this amount for the purpose of growth. So these decisions can also be taken with the help of dividend decisions. Then distribution of profit needs to be done annually or maybe in some interim period, or we have to give this in the form of bonus dividend. So what kind of dividend, in what manner we are giving this share of profit to our shareholders, this also needs to be decided by the financial manager, and when he is taking decision on these matters, it falls under the category of dividend decisions. With this, let us move on the models of dividend decisions. So models of dividend decisions are categorized into two parts, or we may say that there are certain models which are relevance models of dividend decisions, and then we have irrelevance models of dividend decisions. So on the screen, you can see that there are 4 type of models which are written. So these first 2 models, Walter's models and Gordon's model. So these are relevance models of dividend decisions. Relevance means these models says that dividend decisions impacts the value of the firm and share price. So our share price is impacted by these kind of dividend decisions. So we need to be careful while taking these type of decisions. On the other hand, we have 2 models, that is Modigliani-Miller model, or we may call it Modigliani-Miller hypothesis, or residual theory dividend model. So according to these 2 models, whatever decision you will make for dividing or distributing your dividend, these are not going to impact the shareholders' share price as well as the value of the firm. That is why these 2 models are known as irrelevance models of dividend decisions. So our focus of today's session will be on relevance models of dividend decisions. So we are going to discuss these 2 models today, Walter's model and Gordon's model. Let us see what is Walter's model of dividend decision. So this model was given by James E. Walter. He was a professor of finance and he gave this model, and he mentioned that the choice of dividend policies almost always affect the value of the firm. So how we are taking our dividend decisions, what are the policies we are making when it comes to dividend, it is going to impact the value of the firm. This is what Professor Walter said. Now, according to Walter's model, the dividend is relevant to make market price of the share, and dividend decisions are taken on the basis of relationship between R and K. Now what is R? R is our return, okay, or I may also call it rate of return, whereas K is our cost of capital. That is our overall cost of capital, or I may also call it WACC. So when the relationship between these 2 components form, then we are in situation to make our dividend decisions. So this is what Walter model says. Now this model has certain assumptions, and these assumptions are, it says that the very first assumption is that the financing for this model will only be internal financing. That means the funds are not arranged from any outside source. So whatever financing is done, whatever funds are arranged, it has to be done from internal sources within the organization. The returns are constant. Cost of capital is also constant. That means our K will remain constant throughout the time period for which we are doing our evaluation. There will be 100% payout or retention ratio. That means if you are retaining the share of profit, you are going to retain 100% of it. And if you decide to distribute the share of profit in the form of dividend, then you are going to distribute 100% of it. Okay, so there is nothing like in between these 2. Our EPS or DIV will also remain constant. That means earning per share or dividend per share will also remain constant for the period for which we are doing our calculation, and the time period is infinite. So based on these assumptions, the Walter model is drafted. And according to Walter's model, the market price per share is sum of present value of two sources of income. So there are two components in present terms we need to take up so that we can form our Walters model. Out of this, first term is present value of infinite stream of constant dividends. That means we have infinite streams of constant dividends, the dividends which are coming on a regular basis, and these are converted into present value terms. Then we have infinite stream of capital gains as well. So there are two ways in which we are getting return when we are investing as an investor, when we are investing in shares. One is the capital appreciation or the return that we are getting, and another is dividend. So in the first part, we are converting the dividend into present value terms, okay, and in second part, we are converting the earnings into present value terms, okay. So by adding these two things, the present value of infinite stream of constant dividends and infinite stream of capital gains, when we are adding these two terms, we can form our Walters model. So our Walters model can be presented in the form of this equation, where the price of share, today's price of share, will be equal to dividend plus R upon K, where R is our return and K is cost of capital, earnings minus dividend, and the whole amount has to be divided by K. Okay. The same equation may also be written in this form. So dividend upon K plus R by K multiplied by EPS minus dividend, and the whole figure, whole numerator, has to be divided by K. One thing we need to remember while dealing with Walters model, that our DP ratio, that is dividend payout ratio plus retention ratio, should always be equal to 1. That means 100%. So we cannot go beyond this. So if we are considering dividend payout ratio to be 40%, so our retention ratio will be 60%. In case we are considering our dividend payout ratio to be 70%, so our retention ratio will be 60%. So it cannot be any figure in between this. So ultimately the summation of dividend payout ratio and retention ratio has to be 1 or 100%. Now this model can also be summarized in the form of a small table which will be visible on your screen. So there are three different types of firms we are considering here. One is growth firm, the firm that is growing, that is in the growth stage. Then we have a normal firm, okay, which is a stabilized firm, I can say, and then we may have a declining firm. So when the firm is a growing firm, okay, so in this case our return is more than cost. That means we are getting more return as compared to the cost which we are paying. In this case, what we should do, our dividend payout ratio should be 0. That means we should consider the situation and we should not pay dividend under while we are dealing in a growth firm. Because if we are retaining the amount 100%, we can again invest this amount for the purpose of growth. Our firm is in growing stage, the firm will definitely utilize this amount and the returns will improve after this. So when there is a situation of growth firm, in this case what will happen, the dividend payment, the dividend which has to be paid at the end of first year is lower, the amount will be is reduced, and the price of the share will be higher in this case. Whereas when it comes to declining firm, if the firm is declining, so when the firm can be defined as a declining firm, when the return that we are getting is less than the cost that we have to pay. So when our return is less than cost, that means we are dealing in a declining firm. Now what we should do in this case? In this case, we should pay dividend. That means our dividend ratio can be 100%. That means we can completely distribute the profit that we are earning in the form of dividend. What will happen in this case? The dividend that we are paying at the end of first year will be higher, but the price of share based on this will be lower. Okay, so this is the case when we are dealing with declining firm. Then we have another case when we are dealing with a normal firm. Now when we are dealing with normal firm, in this case what will happen? This is the situation when our return is able to balance the cost that we need to pay. That means our return is equal to the cost of capital. Okay, in this case what will happen, the market price of the share is indifferent to DP ratio. So whatever ratio you are, whatever dividend percentage of dividend that you decide to distribute, it is not going to impact much the market price of the share. Okay, so market price of the share will remain indifferent to DP ratio in case of normal firm. Let us try and understand this concept of Walter model with the help of one practical example. The question is visible on your screen. In this case, we are considering EPS as rupees 10. Our cost of capital, or I can say our WACC, is 10%. There are three cases we are considering here when our R is 15% rate of return. Second case 10% and third case is 6%. And these three cases can further be tested for four situations when we have payout ratio 0%, payout ratio to be 40%, 80% and 100%. We need to capture the effect of dividend policy on market price of the share using Walter's model. So we need to use our formula and we need to do the calculations, okay, to get what would be the market price under different scenarios that is given in our question. So this can be, the solution can be presented in the tabular form to present the solution neatly and understandable for the examiner as well when we are solving this question as student in our exams. So this whole question can be summarized in the form of this table. Okay, here K is 10% in our question and E is 10, which is constant for all the situations. So there is one situation when our R is more than K. So since our R is 10% and R is 15% in this case and K will remain fixed, that is 10%. So this is the case 1. Case 2, whenever R is equal to K, that means R is also 10% and K is also 10%. And third case, when our R is less than K. So R in this case is 6% and K will remain same, that is 10%. Okay. We have to solve this for four situations of payout ratio. One is 0%, 40%, 80% and 100%. So we have to calculate the value of this cell, then this and this. So like this, we have to solve, do the solution for 12 times. So let us see how we can solve this for the very first cell. We just need to use our formula of Walter's model and we need to place the values which are given to us. So in the first case, our dividend is 0. So in case of DIV, I am replacing DIV with 0. K is given as 10%. R in case 1 is 15%. Remember the first case was of growth firm where our R is more than K. So R here is 15%. This has to be divided by K, which is 10%. EPS is again given rupees 10. So 10 exactly, we will write 10 here. We have to subtract 0 because in this case payout is 0, the very first case. So our dividend payout or DIV or the payout amount will remain 0 here and the whole amount has to be divided by K, that is 10%. Okay, this is 10% only. By solving this part of equation, we will get P0, that is price of share as rupees 150. So similarly, we have to repeat this kind of calculation 12 times to fill the question marks in our table. And our table will look like this when we will fill this question. The question marks will be replaced by the values that we are going to calculate. So in first case, wherever R is more than K, that means our R is 15%, K is 10%, EPS is rupees 10 and payout ratio is 0. So in this case, the price of share is rupees 150. Okay. Similarly, when we are going to do the calculation for 40%, the price of share is 130 rupees. When we are going to do the calculation for 80%, the price of share will become 110. And when our payout ratio is 100%, the price of share will become 100 rupees. In case of normal firm, when we will do the same calculation, we can see that the price of share remains unchanged. But in case of declining firm, the third case, whenever R is less than K, R is 6% in this case, K is 10%. We can see that the price of share is increasing when our payout ratio is also increasing. So therefore, we can say that yes, the concept of Walter's model is justified. So when our R is more than K, and we are increasing our payout ratio, because in this condition, in case of growing firm, what was suggested that our payout ratio should be minimum or it should be 0. So that would be the best case scenario when it comes to normal firm. So yes, it is proved, we can see that it is proven by this Walters model, since our share price is maximum in first case when our payout ratio is 0, and the share price is reducing, it's falling when we are increasing the payout ratio. In second case, when we have normal firm, so it was concluded by Walters model that the price of share will not get impacted by the payout ratio or our dividend policy. It is again proved by this practical example that whatever our dividend payout ratio, be it 0%, 80% or 100%, the share price will remain same, that is rupees 100. But in third case, when we have this declining firm, okay, where our R is less than K, in that case, Walter suggested that we should increase the payout ratio. The payout ratio should be increased, and it can go up to 100%, which is again proved by this practical example. So when we are increasing our dividend payout ratio, as and when our dividend payout ratio is increasing, the price of share is also increasing. So this is what our Walters model said. We have another model, that is Gordon's model, which was given by Myron Gordon, and Gordon's model explicitly relates the market value of the firm to dividend policy. So this model also says that our dividend policy is going to impact the price of the share. Just like Walters model, it also has certain assumptions that we are considering it to be an all equity firm. There is no external financing. The returns are constant and cost of capital is also constant. The earnings are perpetual in nature. We are not considering corporate tax here. The retention ratio will also remain constant, and K, cost, is more than G, that is growth rate. So Gordon's model can also be summarized in the form of this equation. It says that just like in the previous case, we have constant dividends, stream of constant dividends, and the earnings. In this case, our model is dependent upon the market. This model says that the market value of share is equal to present value of an infinite stream of dividend received. So this model is dependent upon the dividend amount. So present value of dividend received in the first time period plus present value of dividend received in the second time period, and so on up to infinity. When we are going to add this, we are going to get this formula for our Gordon's model. Okay. And the dividend per share is expected to grow when the earnings can be retained, and dividend per share is equal to payout ratio. Okay. So this can also be drafted, or we can say, or we can reframe this formula in this form, when when the price of the share can be calculated by multiplying the dividend amount with 1 plus G, that means the concept of growth is also incorporated here, and dividing by 1 plus K, so that the amount can be converted into present value terms. So this has to be repeated for multiple time periods, and by adding these, we will get this value, that is div 1 plus G raised to the power 10, and this whole amount has to be divided by 1 plus K raised to the power T. And we have to do summation of this so that we can get the value of all of these terms which were taken on the upper side here. By using this particular equation, we can get the formula for Gordon's model. What will we do? We will substitute EPS 1 minus B, and this amount has to be replaced by dividend for the first year. So instead of DIV, which was given in the previous equation, we will now write EPS 1 minus B. Okay, B is retention ratio here. This whole amount has to be divided by K, which is cost of capital, multiplied by B and R. B is retention ratio and R is our rate of return. And by using this formula, we can calculate the value of P, that is price of the share, using Gordon's model as well. So let us understand this with the help of one practical question. Again, in this question, the price of the share is given as 10, K is 10%. We have 3 different scenarios for R and 3 different scenarios of payout ratio. Let us calculate the value of P so that we can quickly fill or replace this question mark. Again, this table also shows the summary of Gordon's model here. So let us see how we can calculate the value of first cell. We have this formula of Gordon's model. EPS in our question is rupees 10. So EPS is replaced by 10. B, that is retention ratio, is 60% in first case. K, that is cost of capital, minus G. What is G? G is retention ratio multiplied by rate of return. So retention ratio here is 60% and our rate of return is 15% in case 1. Now by solving this equation, we can see that the price of the share here, it will come as rupees 400. What we need to do, we just need to replace this amount with a question mark which is given in the blank table where we have summarized the question. So again, from this table also we can conclude that when the R is more than K, that means this is the first case when the firm is a growing firm. Okay, in this case our R is 15% and K is 10%. We can see that our payout ratio is 40%. When our payout ratio is 40%, the price of the share is 400 rupees. When the payout ratio is 60%, the price of the share will become 150. And when our payout ratio is 90%, the price of the share will become 106. Again, it is proof that when we are increasing the payout ratio, the price of the share is falling. Whereas in case of declining firm, where R is less than K, R is 6%, K is 10%. So when our dividend payout ratio is 40%, the price is 62.5. And when the payout ratio is increased to 100%, the price of share has also increased to rupees 95.75. But in case of normal firm, when our R is equal to K, the change in dividend payout ratio is not impacting the price of the share at all. So the price of share is same under all the three circumstances. So this is how we have proved the Gordon's model with the help of this practical example as well. So this is about these two models, two relevance models of dividend theory that we have discussed today. So that is all from my side for this session. So today we discussed about the definition of dividend, what are relevance and irrelevance model of dividend, out of which we discussed two relevance models of dividend theories, that is Gordon's model and Walter's model. So thank you and happy learning till the next session.